Toyota is the world's largest automaker, a company famous for manufacturing discipline, reliable vehicles, and one of the most successful hybrid strategies in automotive history. But this week, Toyota is expected to report something unusual: its fifth consecutive quarterly decline in operating profit. Analysts expect the company to post roughly 1.11 trillion yen, or about $7 billion, in operating profit for the April to June quarter. That would still be an enormous amount of money, but it would be about 5% lower than a year earlier. The decline comes as global sales weaken in several important markets, production costs rise, and a powerful earthquake disrupts parts of Japan's automotive supply chain. This creates a surprising contradiction. Toyota's decision not to abandon hybrids for a fully electric future now looks increasingly intelligent. Hybrid demand remains strong, especially in markets where drivers want better fuel economy without depending completely on charging infrastructure. Yet the company that appears to have made one of the industry's smartest technology bets is still watching its profits fall. So what is actually going wrong? The answer is that choosing the right vehicle technology does not protect an automaker from every other part of the business. Toyota may have positioned itself well for the transition between gasoline and electric cars, but it still depends on millions of customers, thousands of suppliers, stable shipping routes, affordable materials, and factories that must operate with extraordinary precision. When one part of that system weakens, the effects travel through the entire company. Toyota and Lexus sold just over 2.5 million vehicles globally during the latest quarter, about 3% fewer than a year earlier. The United States provided modest growth, but that was not enough to offset much sharper declines elsewhere. Sales dropped around 28% in China and by roughly one-third in the Middle East. Toyota also lost ground in Oceania and parts of Central and South America. China is especially important because it shows how quickly Toyota's traditional advantages can become less powerful. For decades, Japanese automakers built their reputations around quality, fuel efficiency, durability, and strong dealership networks. Chinese competitors are now attacking several of those advantages at the same time. Companies such as BYD are offering electric and plug-in hybrid vehicles with advanced software, aggressive prices, rapid product updates, and increasingly strong brand recognition. Toyota still has an enormous customer base, but Chinese buyers are no longer choosing foreign brands automatically. Domestic manufacturers understand local digital preferences, introduce models quickly, and control more of the battery supply chain. This means Toyota is not simply competing against another car. It is competing against a different production system. A traditional global automaker may spend years designing, testing, approving, and launching a vehicle. A fast-moving Chinese competitor may update software, cabin technology, batteries, and pricing much more rapidly. Toyota's careful process reduces defects, but in a market where customers expect constant innovation, caution can also make a product appear old before it reaches the showroom. The Middle East presents a different problem. Conflict in the region has increased material costs, disrupted transportation, and weakened vehicle demand. Toyota said in May that the effects of the Iran war could reduce its annual profit by approximately $4.3 billion. The company forecast a 20% decline in full-year profit even as demand for its hybrid vehicles remained strong. This is an important distinction. Strong demand does not always produce strong profit. Imagine Toyota sells a hybrid vehicle for $35,000. The customer sees one final price. Toyota sees thousands of separate costs: steel, aluminum, batteries, semiconductors, labor, transportation, warranty coverage, dealer incentives, energy, and currency movements. If the cost of materials rises by $500 and shipping adds another $300, Toyota either accepts lower profit or raises the price. Raising the price may protect the margin, but it could also reduce demand. Large automakers operate on this balance across millions of vehicles. Even a small cost increase per car becomes enormous when multiplied across global production. Toyota's previous financial results already showed the pressure. Its operating margin fell from 11.9% in fiscal 2024 to 10% in fiscal 2025, and then to 7.4% in fiscal 2026. The company remained profitable, but the amount retained from each unit of revenue became significantly smaller. Then came the earthquake. A magnitude 7.1 earthquake struck southern Japan and disrupted automobile and semiconductor operations across the region. Toyota stopped production at 4 domestic plants after supplier facilities were affected. Aisin, one of the automotive industry's most important component manufacturers, reported damage but said that improvements introduced after earlier disasters helped limit the impact. For Toyota, this is not merely a temporary factory closure. Its production system is designed around efficiency and low inventory. Components arrive close to the moment they are needed instead of sitting for months inside expensive warehouses. This just-in-time system reduces waste and allows Toyota to react quickly under normal conditions. But efficiency can become fragility during a disaster. A vehicle assembly plant may contain thousands of workers and expensive machinery, but production can stop because one small component is missing. A seat mechanism, braking part, sensor, semiconductor, or transmission component can prevent an almost complete vehicle from leaving the line. The factory itself may be undamaged. The system surrounding it is what fails. Toyota has spent years strengthening its supply chain after previous earthquakes, floods, fires, and semiconductor shortages. Suppliers now share more information, critical components are tracked more closely, and some facilities have been reinforced. The relatively limited initial damage reported after the latest earthquake suggests those preparations may be working. But the event still exposes a fundamental risk. Toyota's scale is one of its greatest advantages, yet that scale depends on a global network with thousands of points of failure. The company must now decide how much redundancy it is willing to pay for. Holding more components, supporting alternative suppliers, and spreading production across different regions can reduce risk. But every additional backup increases cost. This is the same trade-off Toyota faces with vehicle technology. Its hybrid strategy is based on flexibility rather than one universal solution. Toyota calls this its multi-pathway approach. Instead of assuming that every country will adopt battery electric vehicles at the same speed, the company offers hybrids, plug-in hybrids, battery electric cars, hydrogen vehicles, and conventional engines depending on local infrastructure and customer needs. That approach was criticized when investors believed pure electric vehicles would replace combustion engines almost immediately. The market has become more complicated. Many consumers want lower fuel costs and reduced emissions but remain concerned about charging time, vehicle prices, range, or access to home charging. A hybrid solves part of that problem without requiring the driver to change daily behavior. Toyota has spent decades improving this technology. The Prius turned hybrid power into a mass-market product, and Toyota has since expanded the system across sedans, SUVs, vans, and luxury vehicles. The company is now reinforcing that position. Toyota has invested heavily in American battery production and hybrid manufacturing. Its large battery facility in North Carolina is expected to support more than 600,000 hybrid vehicles annually, while additional investments are expanding production across several United States plants. This gives Toyota a valuable advantage. While competitors rushed to develop fully electric lineups, Toyota maintained factories, suppliers, engineering knowledge, and customer trust around hybrids. When electric adoption became less predictable, other automakers began adding hybrids back into their plans. But this success contains a hidden risk. Hybrids may protect Toyota during the transition, but they cannot become an excuse to move too slowly in battery electric vehicles. China's market shows the danger. Customers there increasingly expect electric platforms, advanced software, fast charging, connected features, and frequent digital updates. A highly efficient hybrid powertrain may not be enough if the vehicle's technology experience feels less advanced. Toyota must therefore make money from hybrids today while building competitive electric vehicles for tomorrow. That requires spending in two directions at once. The company must continue improving engines, transmissions, hybrid batteries, and existing factories. At the same time, it must develop new electric platforms, software, battery technologies, and production methods. A smaller company might choose one direction. Toyota's size allows it to pursue several, but size does not make the investment free. There is also a product timing problem in the United States. The redesigned RAV4, one of Toyota's most important and profitable models, has faced a slower sales ramp-up than expected. When a high-volume vehicle changes generation, factories must adjust, dealers must manage old and new inventory, and customers may delay purchases while waiting for the updated version. One model does not define Toyota, but a vehicle such as the RAV4 sits near the center of the company's business. It combines strong demand, recognizable branding, relatively high pricing, and hybrid appeal. A delayed or weak launch can affect revenue, factory utilization, and dealer profitability across an entire region. This explains why Toyota's fifth expected profit decline is not evidence that its hybrid strategy has failed. The pressure comes from several directions at once: declining sales in China and the Middle East, higher material and transportation costs, production disruption, currency risks, and the cost of investing in multiple future technologies. Toyota's real challenge is not choosing between hybrids and electric vehicles. It is protecting the cash generated by today's products while paying for tomorrow's industry. The company remains financially powerful. Even the expected lower quarterly profit would exceed the annual earnings of many global corporations. Toyota also enters this period with one of the strongest brands, broad geographic reach, extensive manufacturing experience, and a hybrid portfolio that competitors are now trying to rebuild. But large companies rarely collapse because every part of the business fails at once. They weaken when small disadvantages accumulate faster than management can remove them. A few percentage points of lost sales in one region. Higher material costs on each vehicle. A factory shutdown lasting several days. A delayed model launch. An electric product that reaches customers later than a competitor. Each problem may appear manageable. Together, they can steadily reduce profit even when the core strategy remains sound. Toyota's upcoming earnings will therefore reveal more than whether one quarter was better or worse. They will show whether the company's famous production system and multi-pathway strategy can absorb a world that has become less predictable. Toyota may have been right that the automotive future would not arrive through one technology at one speed. Now it must prove that flexibility is not only a good theory. It must also be a profitable business,